Hey guys and gals, this is Logan Freeman, and this is the LiveFree Investors Podcast, where I interview investors and business owners who share investment advice so you too can live free. Today, I'm talking to Michael Brady. Mike, in a few sentences, tell us who you are and what you do.
Yeah, sure. Thanks for having me on, Logan.
Of course.
So I'm Mike Brady. I am not the father of 3 boys and 3 girls, nor do I have a wife named Carol. I have the 3 boys, though. I'm also not related to the quarterback, unfortunately. Yeah, I might be doing something else if that were the case, maybe managing him.
Yeah.
But what I am is I'm a real estate attorney by training. Been practicing law for over 26 years.
Wow.
Got involved in the 1031 space, 1031 exchange space pretty early on in my career. Almost within a year of practicing law, I was asked to handle a 1031 exchange. Did a number of those over the years and got involved as a qualified intermediary in 2005. And I've been with Madison for a little over 2 years, heading up sales and marketing and some structuring issues for our clients.
Awesome. So I'm curious, break down what a qualified intermediary is for folks that might not know first. Let's do that first.
Yeah. So when I first heard the term qualified intermediary, and this is when I first started practicing law, I thought it meant you had some kind of special training. You were qualified, right? You went to, 1031 exchange school and you got a certification to be qualified as an intermediary. And what I ultimately discovered was really all you need to do to be a qualified intermediary is not be a disqualified person for tax purposes.
Okay.
So an agent of the taxpayer, that could be their attorney, their accountant, their real estate broker, cannot be their qualified intermediary, but really anybody else can be. And essentially what we do is we are the middleman in the 1031 exchange. And essentially that allows the taxpayer to basically do what we call a 4-party transaction, but for tax purposes, it's going to be a swap of one property for the other. And that's the crux of the exchange concept, that the taxpayer is just trading one property for the other. Okay.
Yeah.
And if you and I, for instance, each had a property the other liked and we traded deeds, that's automatically a 1031 exchange. That doesn't happen. So what happens is for tax purposes, they're going to give us their property. We then sell it. We take the proceeds from that sale and we buy a property from somebody else. And then we give them, our client, that property in exchange for the one they gave us. Okay, so that's essentially the function we play for tax purposes. The process is a lot less cumbersome. Okay, so it's sufficient if the deeds go from seller to buyer on each side, like they always do, and just the money has to flow through us. So the taxpayer doesn't touch the money, they just get a property in receipt for the one that they gave up.
Makes sense. Okay, so how long has the 1031 tax code been in effect?
Almost 100 years, believe it or not, in not under Section 1031, but it's been in the concept of exchanging has been in the tax code since the 1920s. I believe it's the late 1920s.
Yeah, I'm just doing a little foreshadowing here for a question that I'm going to have for you later.
Yeah. So I just wanted to stress that as we get to that, this is not some loophole, right? This is not something that, like you hear every now and then people are telling you, you don't have to pay federal income taxes. It's unconstitutional, right? You hear all these scams that are out there. This is not like that. This is something that's part and parcel of the tax code, the modern tax code since the 1920s.
Absolutely. There's been a new concept where you can defer. I've had quite a few people reach out to me talking about a newer concept where you can, I don't know exactly the structure, but you can somehow have somebody that gives you a private loan and you can defer this. And I know for a fact, because I called some really qualified folks and the IRS is not accepting all of those technically. Talk to us about what I'm talking about, the name of it, because some folks get confused. They say, well, I've heard about this other concept, but what is your take on this? And I don't even know the name of it.
I think the concept you're talking about, and it has a couple of different names. The one that's out there is called the Deferred Sales Trust.
That's right.
Essentially they use an installment payment, so essentially under a different tax code section. And we sometimes see this even within 1031 exchanges, that if you sell your property to a buyer and the buyer gives you, instead of giving you cash, they give you back a promissory note. They give you back paper, right? So they're going to, essentially, they're borrowing from you to buy your property, okay? The benefit to you as the seller in that situation is you don't pay taxes on the money until you receive it.
Right.
Okay. So you may be getting payments year one. You'll get taxed year one on the principal payments that you receive, but not on the entire balance. So you're deferring automatically under Section 453 under what they call installment treatment.
Okay.
Okay. And I'm not an expert on the deferred sales trust. And I know there's a couple of different companies out there that do structured sales and some different things that they do. So I'm not an expert on that, but I likewise have talked to, various people. I've analyzed those programs. I was at a conference actually in California where a tax representative from California was very, very down on the concept in general of using this other structure that you're talking about, whereby essentially it's almost an artificial, promissory note in the transaction. So, I won't comment it on beyond that. They've been out there for a while talking about them. They have not been around since the 1920s. I don't believe that they have the kind of case law and everything else that we have behind Section 1031 to kind of give you the ins and outs on how it should work.
Yeah. Well, let's talk about the 1031 exchange and why it's beneficial. So if I'm a property owner and, I'm looking to sell my property, tell me a few reasons why I would want to do a 1031 exchange. And then also, when do I contact you, right? So what is my steps and what the process is that I need to go through to make sure that I'm checking all the boxes?
Yeah. So let me touch on that first, because it's the most important thing you and I are going to talk about. So essentially, you need to set up the exchange before you close on anything. Right? Whether it's your acquisition or your sale, you need to contact us and get us involved early in the process. I always recommend that you also talk to your accountant well before you even list the property for sale to make sure that what you're thinking makes sense, whether it's a straight sale or whether it's a 1031 exchange. So that's important. When would you do it? Really, anytime you're selling appreciated property. If you're selling a property that has a profit, I shouldn't say anytime, but if you're selling a property that has a profit, you should be looking at the 1031 exchange, because especially if you're going to buy other property anyway, because the tax implications are pretty significant if you do not do an exchange. Depending on where you and your property are located, you're going to pay various levels of taxation. So the federal taxes, capital gain taxes, and I'm talking about property you've owned for over a year. Well, I'll back into that in a second. Because the long-term capital gains rates kick in when you've owned the property for 1 year and 1 day. And their preferential rates, they're lower than income tax rates for the most part, but the rate still is 15 to 20% of your profit. On top of that, you may pay a net investment income tax of 3.8%. And then if you live in a state that charges income taxes, such as New York and California, well, California taxes are double digits. You're talking over 10% income taxes marginally in California. New York is pushing close to 10. It's in the high 8s to 9% range. And then, for example, I'm based on Long Island in New York, so I'm not too far from New York City. We have a great office in New York City that I would go to before the pandemic, and now I hide from. But New York City charges a tax that's a marginal rate of 3.648%, and there are other cities that charge taxes at all. As well. So you're talking about almost a third of your profit comes off the table if you do not do a 1031 exchange.
Right. Yeah. So that's really important. Let's talk about the basis. So, I know that there is sometimes when folks are, buying properties and using depreciation and adding value to them, sometimes they don't really understand this, well, what is my actual basis and what do I need to defer into utilizing a 1031 exchange? So if you can break that down and simplify that, that would be amazing for us.
Sure. And that's one other layer of tax that I forgot to mention, actually, is that if you have depreciated your property, that there's a great income tax benefit while you own the property. However, when you sell, that depreciation gets recaptured and taxed. The real estate portion of it gets taxed typically at a top rate of 25%. But if you've done a cost seg, which we were talking about earlier with my colleague Yona Weiss, to the extent that you've reclassified some of that as personal property items, the tax rate is much higher on that portion of the depreciation. So that adds up as well. So
absolutely.
The way it works in a 1031 exchange is many people think that they just have to reinvest their profit. right? So if I bought a property, I'm going to ignore depreciation. I bought a property for $200,000 and I'm fortunate enough to sell it for $1 million, that I only have to reinvest $800,000 in my replacement property. And that's not the way it works. If you're doing a qualified opportunity zone, that's how the qualified opportunity zone program works. It's actually kind of, cool the way that works. That's not for everybody. In 1031 exchanges, though, you also have to reinvest your basis. So the way I describe this is, if you're selling a piece of property, you're going to get 2 bags of money, right? And one bag is going to be your investment, your basis, your cost basis. Every dollar that you put into the property is going to be in the basis bag. And the other bag is going to be your profit bag, okay? When you go to do a 1031 exchange and you're putting those 2 bags of money in the new property, the first bag of money that goes is your basis bag, right? So that if there's any money that's left over, it's coming out of your profit bag and it's going to be taxable.
Sure.
So you need to do 2 things to fully defer your gain in a 1031 exchange. You need to buy property that's equal or greater in value to the one that you sold, and you need to spend all of the proceeds from the sale. If you do those 2 things, the debt will take care of itself, because you'll have to replace the debt or come up with additional cash.
Absolutely. So, I think about this in the way, I love that analogy of the 2 profit bags. I think that's really important, but folks have to realize too, like, say you buy that $200,000 property, you add $50,000 to it, right? But then you need to make sure that you're talking with your accountant to understand what your true basis is, because that basis that's where the depreciation really starts to come into play, because you get that recaptured, like Mike said. So it can get somewhat complicated, especially if you start to say, well, what if I own the property outright and I don't have any debt and all these different things, right? So that's why I find that, working with an expert when we're doing these 1031s is extremely important, because you don't want to make some assumption that your calculations and you get stuck with a major tax bill because you didn't do it the right way. So first off, before you ever get ready to list a property, talk to your accountant, but also get involved with a QI that knows what they're doing, that can be trusted, and that can help you through the process, because it's really, really important, because you cannot touch that money, or basically you're on the hook, really. So what are some other rules around the 1031 exchange, right? So if we're working together, we're getting ready to list our property, and say it goes under contract and it closes, right? So where do those proceeds go? And then what are the timelines that I need to stick to afterwards?
Right. So as I said before, you're going to call us before you go to closing. And we'll talk about a forward exchange. A forward exchange is when you sell first, then buy. That's the most common that we handle.
Yep.
So we set everything up. You'll be some additional documentation you're going to have to sign at or prior to closing. You're going to have to give notice to the other party, your buyer, that you're doing an exchange. We have a notice document that does all that. And then you'll close, and we'll work with whoever's handling the closing. If you're in an attorney state, typically we work with your attorney. If you're in a non-attorney state, we typically work with the title closer. And so what will happen is you'll close, all your transaction costs get paid. So you pay off your mortgage, you get to pay your broker, right? You get to pay any transfer costs that you have, transfer taxes, recording fees, things like that. The net proceeds then come to us, okay? We put it into an escrow account, okay? We don't do anything speculative with the money. Other companies have done that in the past. They've gotten themselves and their clients in trouble. This just goes into an escrow account. We have the ability to set up a segregated account that will have the taxpayer's name and tax ID number as a sub-account under our master escrow account.
Makes sense.
Then you have 45 days from that closing of the sale to identify the replacement property in writing. That's usually simply, you close on Monday. On Tuesday, we are going to send you a letter saying, "Dear exchanger, we have your money, and here's a form. You need to fill out this form and tell us the properties you are interested in buying."
Okay.
You have to do that within 45 days. You can identify several properties. You can identify up to 3 regardless of the value. If you exceed 3, then the total value of what you identify cannot be more than double the price that you sold your property at. So if you sold for $1 million, you can only identify 4 properties or more up to $2 million of value. Okay, that's just so you don't just put down as your identification the Kansas City phone book and say I'm going to buy a property in Kansas City. So you have to limit it. Then within 180 days, up to 180 days from your closing, you have to close on some or all of those properties that you identified in the first 45 days.
Yep. That's really great to know. And I think it's important to note right here, this is where you want to obviously be working with a broker in the neighborhood or the market that you're interested in. And they need to be, very, very in tune with bringing you properties that fit your, your criteria, because 45 days goes a lot faster than you think. Now, during the pandemic that we've had here, there was, there was an extension to this, thankfully. I was in the middle of a lot of 1031 exchanges, and we were able to, extend that date because of COVID. But at the same time, I think folks still say, well, I'm going to have all this time to identify properties. What we saw happen was, July 15th, right? So, come a week before July 15th, everybody was trying to identify properties. And so you need to be proactive in this process and don't sit on your laurels, because I think there's a lot of folks that do, and then they get stuck with a property that maybe they don't really want to own, and so there's other options. You can talk with providers of DSTs and things like that, but you really need to be proactive throughout that process. So thanks for breaking that down for us. I really appreciate that. It's really important to have experts working with you on these transactions. So
no, absolutely. And just to back that up, as you said, there was that mad rush by July 15th, which went very, very quickly.
Yes.
And so there are options. There are things like the Delaware Statutory Trust out there, but listen, they went just as fast. I mean, there's limits on Delaware Statutory Trust. So working with somebody like yourself in somebody that knows the market, and especially because of those deadlines, being able to kind of give you a decent property that you're not going to have to worry about the due diligence so much on, or you're going to go down the garden path and find out the property just doesn't make any sense, right? The numbers don't add up. So yes, absolutely. People need to work with people that know the market, and experts like yourself certainly make that process a lot easier.
Yes. So when thinking about this from an estate standpoint, when I'm thinking about leaving a legacy, a lot of folks want to leave a legacy to their families. Talk to us about the benefits of, quote unquote, taking your property to the grave, and what benefits that might have to having a step up basis for the folks that you're leaving that property to.
Yeah, there's 2 aspects to this I'd like to talk about. The first is, which I think you're getting at, is that one of the benefits of owning real property is that you can do exchanges during the course of your lifetime and exchange up and up and up. So you can start with a $100,000 property, do a series of transactions during the course of your lifetime, and wind up with a really nice legacy by going and exchanging up in value every single time as you have appreciation.
Right.
And then leaving that legacy for your family. And the nice thing is that if you die owning property, under current tax law, your estate gets a step up in cost basis and the capital gain disappears. Okay. So that, if they sold it the next day, the day after you passed away, which would be kind of weird if they did that. But
talk about planning, right?
Yeah, right. If they did that, the capital gains disappears. Of course, you always have to be careful of this estate taxes, right? So estate taxes right now, we don't think about too much on the federal level because the thresholds are very, very high. But some of the states have lower thresholds. And so you do have to watch estate taxes.
Yeah.
But yeah, by and large, you can make that disappear. And of course, that's subject to change, as many things in the tax code are. Yes. The other aspect of it is 1031 exchanges provide a nice estate planning tool as well, right? So let's say you had a complicated family situation, and you had a bunch of kids, and maybe you have a bunch of kids by different marriages.
Sure.
Right? That's not an uncommon situation these days.
Yep.
And often what happens in these situations, I've done a fair amount of estate planning and probate work also, is that when, somebody passes away, the mother or the father passes away, leaving that legacy to their children. Well, now you have different competing interests, and you may have a battle royale, depending on how good your estate planning documents are and how good everybody is on, that's a beneficiary. So you can actually use 1031 exchanges. Maybe you're later in life, you're 60 years old, 65 years old, which is fairly young these days, but you have one big asset, right? You have a $10 million property that's going to go to your, 6 children, okay? That they may then have to sell to pay estate taxes if they're, depending on what the thresholds are. What you could do instead is take that $10 million property and exchange it and go buy 6 different properties, right? Go buy 6, I can't do the math. Let's say it's a $12 million property. It makes the math nice and simple.
Much easier.
Yeah. Right. And so you go buy 6 $2 million properties. And then in your will, you leave each kid a separate property, right? Or even better, you put it into a revocable trust, and the trust then, distributes out to the kids of one property each, and they don't have to get along to sell the property or agree. And, and I've seen clients do that. And I think it makes a lot of sense for somebody who's, got the bulk of their legacy in real estate.
All right, man. Thank you so much. I really appreciate that. I will make sure that folks point to you and know where to go to get in touch with your organization. I want to segue, because you're a successful guy. You've been in the business for a long time, and these are some questions that I always ask folks. But I'm just curious, what's the best advice that you've ever received as an investor and a business owner?
I said this in other places too, but I always think it's particular to my business. Number one, is that you never want to let the taxes drive the train, right? So you're much better off paying taxes than making a bad real estate investment. So in 1031 exchanges, don't just identify a property for the sake of not paying taxes. Make sure it makes sense. Kick the tires, and make sure you're working with people who can steer you in the right direction on those properties. So that's very important. But the other thing I think that I learned very early on in my career as an attorney is just the importance of due diligence in general, right? Always prepare. Know what you're doing. And if you don't know what you're doing, walk away.
Yep.
You're better off, doing that than I think, going in over your head. Warren Buffett, I think said that. Warren Buffett did not invest in Microsoft despite his friendship with Bill Gates, because he did not understand computers for many years.
Yep.
Right. And he probably left a lot of money on the table by doing that, but he didn't understand computers. Yeah. And so he wasn't going to invest in it.
Absolutely. I think that's great. Stay in your zone of genius. If you don't know something, don't just assume that you do. There are experts out there that you can work with. So this is a social show. You're a well-connected guy. We run in some different circles, but this is your opportunity to promote somebody on the show that you might think would be a good fit to be on the LiveFree Investors podcast. So I'm putting you on the spot here, Mike, but do you have anybody that would be a good guest for us to interview?
Yeah, sure. So I have a good attorney, Matt Rappaport. I don't know if you've run across Matt, but no. Matt is a really good tax attorney. And Matt has a great knowledge of qualified opportunity zones.
Awesome.
So if you have any investors that are interested in that, I talk about them. I never figured out how to make money on them. So my incentive isn't there to know everything there is to know about qualified opportunity zones. So Matt is a really good resource.
We are actually completing 2 qualified opportunity zone projects right now. So
wow.
I would love to speak with Matt. So I might ask for an introduction there.
Absolutely.
Yeah. Okay. This is really important. Where can people find more information about your company, your organization, and who do they reach out to before they start to list their property so they can get this process started?
Yeah, absolutely. So they can reach out to me. I love that. I'm on LinkedIn as you are. We're connected on LinkedIn, but you can look for me on LinkedIn. Again, I'm not the architect. I'm the guy that does 1031 exchanges. You can always reach out to me by email. I check my email. I read the 4-hour work week.
Yeah.
But I never figured out how to live it. So I check my email every single probably 15 minutes or so. And
I'm guilty too. I'm guilty of that as well.
Bad habit, but it helps my response time.
Well, we'll make sure that folks can get a hold of you one way.
Yeah. And, and I'm always, you can always reach out to me. Our website is madisonexchange.com.
Perfect.
We're actually in the process of revamping some of that, but we have a blog on there also where I post a couple of times a month. I'm a little bit behind, but we do topics on there.
All 50 states?
All 50 states. Yep.
That is awesome. That is so great. So if you're listening in California, New York City, Missouri, Wyoming, wherever you're at, these guys can take care of you. Okay. This is Logan Freeman with the Live Free Investors Podcast, where investors and business owners share advice so you too can live free. For more insights and ideas on how you can live free, connect and message with myself and with Mike Brady on LinkedIn today. Mike, thank you so much for joining us today.
Thank you, Logan. This was great.
And until next time, live free.